Howdy, Jacob here. Today we're looking at Alpha Metallurgical Resources in the metals and mining industry. This is a big buy by my boy Mohnish Pabrai. I say my boy, I've never talked to him, but definitely look up to him as a great investment figure. And he, in the last year and a half, has heavily been investing in Alpha Metallurgical Resources, along with Arch Resources in the metals and mining industry. I've listened to some interviews with him, and it looks like there was a 6-month period where he really dug deep into the metals and mining industry and picked out, at least currently, 2 companies that he thinks are going to be long-term winners. And I know he's not like a Michael Burry where he buys stuff and gets in and out sometimes pretty quick. He usually holds on, and so I mean, that's what made me look at this company initially on my own terms. And then when I was looking at it, it looks pretty interesting. So I definitely wanted to bring it to this generic screener and see where we're looking at and just go over some of the figures and then maybe do a deeper dive if it's looking attractive enough. So 2.8 billion market cap on 2.45 billion enterprise value. They do pay a dividend. It's almost 1% on a dividend yield basis. And in relation to their earnings, it is absolutely nothing. Their revenue growth has grown crazy in 2021 and 2022, and then they're actually down 15% year over year. Again, makes sense. There was some big inflationary periods for metals and mining industry and oil and gas, and so it doesn't surprise me that there was some huge increases in revenue there. So we might go back to more historically norm figures, but even still, their gross margin and operating margin are nearly identical, meaning that really it's just the cost of goods sold being an entirety or 90% of expenses, with maybe 10% of all their other expenses being sales, general, and admin to get to their operating margin here. So we do see huge earnings per share swings. So we have negative 24 earnings per share, negative 17, but as high as 79 from a year ago. So at that multiple, you're looking at less than 3 times that earnings. But again, it's a cyclical business, so even 6.1 to their earnings right now, it could be possibly higher than their historical average. So we don't know whether they can hold that or not until you do more deep dive research here. So again, like I said, almost all their expenses are coming from cost of goods sold. Doesn't really take anything. They probably don't have that many employees to pay. It's really just their cost of goods sold digging into their revenue. But huge net income here. Free cash flow also very big. This is going to be their CapEx line. Not a huge amount of CapEx in relation to their capital expenditures, especially 2022 and 2023. Before that, margins weren't as high. You may be looking at 200 million average, but more recently they're significantly higher, and they've been buying back shares like crazy. A little bit on the acquisition side, a little bit of paying down debt. But speaking of debt, we did see enterprise value quite a bit lower than market cap. So what that means is their net debt is likely positive, or meaning that they have more cash on hand than their interest-bearing debt. And so 268 million cash on hand with 4 million short-term debt, 7 million long-term debt. The balance sheet perspective, we're feeling very comfortable here. They have a good amount of cash in relation to their debt, and they have a good production of free cash flow, which they are buying back shares at hopefully a cheap price. It looks like they could have been buying back shares kind of expensive since the last 5 years. In 2024 was their most expensive period. I wonder if that was them repurchasing shares, but if they were buying down here where earnings per share or their PE is less than 10, that could be a good benefit for them. And when we look at the shares outstanding, there was actually a year they bought back 17% of shares, meaning that if nothing else changed on the revenue and earnings just year over year, the stock should have gone up 17.6%, keeping that market cap the exact same. So that's a huge amount of share repurchases there. But otherwise, let's get to some assumptions. It looks like their revenue has fallen a bit, and it is quite a bit higher than what it was historically. However, even from here, I think they're able to grow with acquisitions and some reinvestment at a 3% rate of return. I think that's reasonable to me because, again, maybe the next couple of years it does go down, but with acquisitions, with organic growth, with inflation, I think they'll definitely be able to hit that 3% figure. As for margins, historically, they've been closer to 10 and 15%. So I'm going to do a pretty big range of that, 10 and 15%. Share repurchases, 1% for them is about $28 million. And I mean, they can buy a whole bunch of shares with that. So if we're assuming margins go down though. So at 10%, you're looking at about $300 million. And with 300 mil, 50% is about 150, meaning that if they want to buy $150 million in shares, that's about 6%. But let's be a little bit conservative with stock-based compensation and dampened revenue for a little bit. Let's say 4% share repurchases every year for the next 7 years. Terminal PE, it is in the metals and mining industry, so it's not super sexy. Historically, they haven't been given any premiums, so I might feel comfortable with the 13 because, again, they do have a good amount of cash and no debt, so that enterprise value is lower than market cap. Whether they go into debt, hopefully it's for good investment purposes, but for now, 13 at the end of 7 years, saying that maybe growth is not as good as the market, but their balance sheet is better, their ability to return money to the capital to the investor is huge. Historical return on invested capital, massive. So I think I'm comfortable with these assumptions. And again, that's assuming their dividend doesn't get increased at all. And that dividend payout of $23 million is nothing in relation to what we're looking for at like 300 million. And so we're saying about 10% money going towards dividends, maybe 50% to share repurchases, leaving about 40% to acquisition reinvestment to get these type of returns. I think that's also being kind of conservative. So to me, I mean, I can definitely see why Mohnish Pabrai is looking at this company and buying them. For me, I'm going to do more research here. I think this is definitely has the possibility of being an interesting buy at this price. And so I want to understand the business a little bit better to see if I think these numbers make sense. Speaking of Mohnish, I know he'd be very mad at me for doing an Excel spreadsheet on calculation of present value, but it's just the way I understand businesses and the way I can go through businesses very quick. So hopefully he'd be fine with me, rolling through companies quickly and then knowing when I have an understanding of them versus not. So either way, I hope you enjoy this video. I think this can be an interesting business. So I will definitely be doing a deeper dive on this hopefully soon, and hope you have a fantastic rest of your day.